Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest on the show today, Nirmal Jain, founder and chairman of IIFL. Nirmal, thank you very much for joining in. It's the global situation which is the problem. I mean, we keep talking about how India is outperforming, but the global situation keeps getting worse every month. How worried are you that if this continues, despite our strengths, the Indian market might get damaged as well in line with what's going on with the global rout?
No, I agree with you. Then we can't be completely untouched by the global rout, and things are aggravated a lot more than what people expected. So if you look at the US interest rate, then the expectations of the peak rates have been going up every month, and now also people are talking about 4.5, but there's no clarity. You are in UK, you know it better than me probably, that the 2-year bond yield in UK has gone up from 0.4 to 4% in 1 year. And on top of that, there are issues about supply chain bottleneck coming from China's zero COVID policy. There are elections in many countries, including Brazil and Italy. And on top of that, the dollar appreciating is bad for all other currencies. So in this kind of environment, I don't think that one can be, live in a completely worry-free world that India is a sweet spot. Yes, India is doing better. And given the fact that investment, whenever the dust settles, if investment is not going to flow to China and Russia, then by default, India will have an advantage. But having said that, I think the volatility in the currency and the global markets will definitely impact India. And one more thing to worry about India is that the valuations have been at high altitude. So there are concerns and one should be cautious.
Do you see the market going back to the previous bottom that we touched? We are still a couple of thousand points on the Nifty above that. Do you think a retest of that is likely through this painful phase, or do you think this time the bottom might be higher? The price damage may not be that significant. What's your guess?
I would think that India might do better because a few things, in terms of macroeconomic environment has been very good. Tax collections are good. And, India has managed the oil thing also very well by balancing its imports from Russia and other countries. So all things put together, and earnings of some of the sectors have been good. IT is a big sector that will benefit by currency depreciation. But, I don't know. I'm not a technical analyst to figure out where the bottom and resistance are. But if you ask me, short-term volatility is there. But if you, at the same time, whenever, whenever US inflation starts heading down and things start recovering and there's stability, then India will be a big beneficiary, which is much different from the earlier crisis because in manufacturing as well as investment, world is looking at an alternative to China, which is a large economy, and India stands to gain. And on top of that, the stability in political front here and the economic reforms, which government has been undertaking, they will also benefit the foreign investor sentiment. So, just to sum up, whenever things recover, India has a better chance of recovering faster. And Indian valuations, I think, will remain at a premium, given the growth environment being very favorable and also the political environment being stable.
Right. Let me ask you a fundamental question, Nirmal, because while the world is panicking, of course, we'll get hit because of the route through FII outflows, etc. But fundamentally, the fact that we've got a Reserve Bank meeting coming up and where expectations are that they may even raise by up to 50 basis points. What about these factors like rising interest rates in India or some kind of earnings damage filtering in through the global situation? Do you think fundamentally one needs to temper down optimism at all over the next year or so?
I agree with you. The expectations and the optimism has to be controlled, and some of the speculative forces that had come into the market, there will also be very sharp corrections there. Given, I think 50 basis point rate increase is expected in this week's MPC meeting, and primarily because the currency will be under tremendous pressure otherwise. So Reserve Bank will have to look at not only the inflation but also look at the the global developments, and particularly in the US, and the impact of that on the rupee, because a lot of money will now flow to, if you look at US mortgages are now at 6.5%. So obviously, a lot of money will flow to US bonds and US debt market. and that basically will be squeezing the emerging market, and even India can be impacted. And under these kind of environment, I think interest cost will damage, and interest cost beyond a point can damage the demand also. While India will do better than the rest of the world, but expectations have to be moderated. And this year and next year, I think there will be earnings disappointment in many sectors, arising from two things. One is the cost increase because of interest and inflationary pressure in many commodities and even locally. And secondly, the impact on demand because of higher interest and this kind of environment. And also global markets, if they come under a recession, then the exports will be impacted, and that also will affect many industries adversely. So I think, tone down the expectations. We may be better than the rest of the world, but still that doesn't mean that everything will be hunky-dory and any kind of optimism will be rewarded.
Okay, fair enough. And I guess we've been witnessing that in the last few sessions, Nirmal. But where does one look then for a safe investment when it comes to the markets right now? Would you go via specific pockets, or would you stay extremely stock specific at a time like this?
No, I would go rather, if the assets which are to be allocated to equity, I'll have a balanced approach. And at this point in time, if you see, market basically swings, and the two large sectors are tech and technology and bank. So earlier technology were hammered down and there were huge short position there and long bank. And in last couple of days, probably we are seeing a reversal of that. But as an investor, I'd probably make a balanced portfolio. Okay. Of course, bottom up stock picking of fundamental good stocks is good. But otherwise, sectorally, probably one can have a balanced approach. So as far as India is concerned, that maybe a little bit of sweet spot, because if the economy does well, even if 7% might become, in a very conservative scenario, 6%, then also is good. IT, bank, two large sectors, but even capital goods, engineering, all of them should do well, because government probably is, will continue to invest aggressively in infrastructure. Tax collection is good, so that basically gives some more strength to the government's determination or resolve to make sure that they try to propel the economy as much as possible. So I would say that, make a balanced portfolio. I mean, that's the best thing to do.
The thing is, this whole debate about India doing better than other markets is a relative argument. But for people who are watching you today, all their money is invested in India and they care more about absolute returns. So in the last 1 year, we've not made any money from India. We've not gone down, but we're flat. Do you think if you look forward in the next 1 year, Nirmal, is it going to be possible to make out absolute returns, or are we staring at another flattish kind of a year if you look out for the next 12 months?
Very difficult to say, Udayan, at this point in time. But as an investor, you should always have some part of your assets allocated to equity, because nobody has a crystal ball to know how, things can recover dramatically also. So like supposing if there's a war which is not helping anybody, if there's a truce that can bring down the gas or prices, and there can be radical change in the sentiment. And therefore you just can't be out of equity, and you can't be only in equities, because suddenly on the flip side, the risk can, maybe what we are seeing in Taiwan, China, US or Ukraine, things can aggravate. So what we recommend and what I would always say is that allocate certain part of your assets to equity. And so even if you're an India-focused investor, you're not worried about rest of the world, then also depending on your risk appetite, typically say 40 to 60% can be in equities, and the remaining have to be in fixed income instrument. And, depending on if you're really HNI and got a large portfolio, then you can look at real estate as an additional class of investment. But I would say that, you always have to have asset allocation, and you can't be fully in or out of equity.
So you mentioned fixed income, Nirmal. Let me ask you a different question then. If you look at competing asset classes to equity, like fixed income or gold, how do you see those doing in the kind of a global backdrop that we have today, and in the backdrop of rising interest rates in India and overseas? What kind of returns would you expect in fixed income, for example?
I think I would say that they are two different asset classes, and I don't think they compete with each other, because longer term gold has not given the return which can be compared with equity or fixed income, and there is no guarantee or no even reasonable assurance, which you get it in say fixed income. So in fixed income, interest rates are rising, and this scenario may continue for next few months, but not for long term. So you'll have an opportunity to lock in a higher interest rate on a longer tenor bonds or assets. So in fixed income in India, safely today you can get maybe about pre-tax something like 9 to 10% or between 8 and 10% on a good quality corporate bonds. And even the GSEC yield is about close to 7.5. So these are good yields, and tax-free also, if you have various instruments that can give you anywhere around 6.5 to 6.75. So these are the yields that you can look for. In gold, it's very volatile, and nobody can say that whether it will yield you 5%, 10% or so. It's if you are you can put some, and most Indians have. Because if there is a completely war kind of a scenario or a doomsday where neither fixed income nor equity can give you comfort, those scenarios can happen once in a long while, maybe not even one in one lifetime, maybe one in 100 years or so. So that is a very different approach. But personally, I think gold, if you have a jewelry or ornament and every family needs it, so that's a base requirement. It's not an investment class of asset. So just put money in fixed income and equities. Very high HNI, like very ultra HNI, probably they can put some money as an investment class in gold and real estate. But for most investors, buy gold as per need of family or jewelry requirement and not as an investment.
Okay. What about cyclicals, Nirmal? While everyone's so busy talking about what's happening in IT, the India growth story, and banks, of course, being part of that, but there was a phase in the middle when there was a lot of interest in deep value stocks, in some of the cyclicals, and banking on the turnaround story. Is that still a story that one can look at?
I think one should stay invested in some cyclicals, commodities also, because when the commodity prices like say steel, for instance, had gone up, and the stocks have corrected because the global prices also corrected. But, most of the cyclicals are commodities. And there, globally, there are many commodities where investment have not been adequate in last few years. And, therefore, maybe a small part of your portfolio can be in cyclicals as well. Cement, which is a domestic cyclical, which is not dependent on global factors. There also after monsoon, when the investment in infra and demand recovers, that sector also has a potential to do well. So when we say balanced portfolio, I think at least at this point in time, good thing about Indian market is that you can really have a widespread, diversified portfolio because opportunities are there in many sectors. So maybe 5 years ago, there was a time when nobody would recommend any investment in cyclicals, or maybe 10 years ago for sure. But now I think now is the time when probably you can invest in cyclicals as well.
At IIFL, Nirmal, you've got a very good vantage point from both the institutional and from the retail point of view. So how would you say domestic sentiment is like at this point in time? Because for the last couple of months, we've seen some amount of caution creeping in to the very robust DII sentiment that we've seen for the last couple of years. Do you see any problems in the midst of this global panic there, or is the domestic crowd still willing to buy every dip in the market?
So in domestic, the flow of money in mutual fund continues. And, you see the mutual fund ownership now, I think, has become larger than foreign institutional investors as well. So, that comes by way of SIP or whatever. I think there people are still have not panicked. But the direct equity traders and direct equity investors, they have burned. And all this has happened in last few days, last 1 week actually, and last 2-3 days. So probably maybe we should watch out over next few days or a week. But my gut feel is that the direct equity investors and traders will be very badly mauled and hurt in this rout of the market. And probably you will see that, they'll become less active. But the investors and more money is flowing through mutual fund. That seems to be stable at this point in time. The retail money is stable. The HNIs probably will have to take a call. And when they see their NAVs going down, they tend to react to that. If market remains like this, it's obvious that flow of money to equity market, even domestically, will slow down. And another thing that will help is that the yield on bond is going up. So, people, when the bond yields were very low, the risk appetite goes up. So I think some money will flow to the bond and the debt market as well.
The other thing that we saw over the last couple of years, Nirmal, is that the market had broadened out quite a bit. It was not a narrow move up to 18,000 plus on the Nifty. But when 2018-19, which were not as good years for the market had become, you'll remember, very narrow. Only a few stocks like the Asian Paints and HDFC Banks of the world were doing well. In this leg of the global turmoil, is there a chance that the market could again go back to that extreme focus on quality and turn narrow once again? Or do you think the breadth will hold up?
I think given that the domestic participation has gone so much, and domestic investors have tendency to buy mid-cap, small-cap, including the mutual fund. So I think the market breadth will not become as narrow as it was in 2018. When markets are heavily dependent on foreign investors, they tend to choose and they tend to prefer large caps more so. So if you see the ownership of mid cap and small cap, mostly domestic mutual funds and domestic PMS also has become a very large industry. And given that their size is much bigger now, I think it's very valid. I mean, it's a good observation that in the earlier the flight to quality was very, and the markets became very narrow. Markets will become little narrow. I mean, the froth or the very small cap and mid cap will be hurt badly when market corrects very sharply, but still it will be much broader than what you saw in 2018 because of the stronger proportion of domestic money.
Okay, and while we've discussed the implications, Nirmal, we all know that this is going to be a big one from the RBI. What are you expecting? What would you say is going to happen this week at monetary policy?
I think 50 basis point increase. So more or less that's given actually.
All right, and you feel that markets have factored that in given the way that we've
so
been...
RBI will hike the rate by 50 basis point?
Okay, and do you feel that markets have factored that in, or will we see further selling on the back of that?
I think markets have factored in 50 basis point hike by RBI, and markets are looking more at the developed markets, the US markets, and the flow of capital and the currency in particular. So what happened to the US is that they increased by 75 basis points that were expected. But their commentary was something which was even more, that indicated that there can be 2 more hikes in this calendar year, which was not expected earlier. So I think from RBI's point of view also, people look forward to is 50 basis point increase is okay. They're expected, unless there's a surprise there either way. But they will probably look at that what is the commentary that RBI has or what narrative they give about the immediate future in terms of rate hikes.
Nirmal, always good to hear your thoughts. Thank you very much for taking time out for us today. Thank you.
Thank you so much.
If you like the video, do like, comment, share and subscribe.